Hello everyone, this is Terry with Futures.io, and as always I would like to thank you for joining us today. It's my pleasure to welcome back Anthony Drager from Verbal Journal for today's webinar, When and Why, 3 Order Flow Patterns and Setups. Throughout the webinar, if you have a question, please feel free to type them into the questions box. We'll do our best to answer them at the end of the event. This webinar will be recorded and posted on Futures.io website within 24 to 48 hours. If you're watching this afterwards on YouTube, please do us a favor and give us a thumbs up if you enjoyed the webinar. As always, please feel free to share, comment, subscribe to our channel. It really helps us a lot. For trading news, events, and information, follow us on Facebook, YouTube, and Twitter using @Futures.io. And now, without further delay, I'll hand it over to Anthony, and you'll get the pop-up to share your screen again.
All right, give me a second. Let me make sure I got the right screen. There it is. Clean. It says Edge Trading Group. See it?
Yes, sir. Looking good. Sounds good. She's all yours.
All right. And so, like Terry said, guys, I'll answer all your questions at the end. I don't think I see the question. So if you're trying to talk to me and I don't address you, it's because I don't see it. So I'm not going to get into a long bio about me. I've done some webinars for Mike and Futures.io in the past, and so I'm on his YouTube channel. But I came from the floor and a clerk at the CME, a member and trader at the Board of Trade, ready to quit, couldn't make any money, got a job at a prop firm in April 24th, 2000, so almost 19 years to the day. And it kept me in the business, and I started making money almost within the first few weeks. I knew how to trade. Now I was in front of markets that were opportunistic, and that's when electronic trading began to transition from the floor to the computer. And I really just backed into some education when guys would come to see a friend of mine who I knew, and he'd send them out to me. I'm not going to get deep into it, but what I found about traders is that a lot of the stuff that's elementary and basic to guys in a prop firm is not to most of the rest of the world. And there's some things I'll say to people and they'll be like, wow, I didn't think of that. And it's really essential that you do. So let's get started with, like Terry said, the why, the when. I always show this ahead of my videos, a picture of myself right there. See me in the upper left. And my father on the right. Why am I showing you this picture? You've seen my webinars in the past. He always tell his kids, if you know how, you'll have a job. If you know why, you'll be the boss. I'm bringing that up because order flow is the why. It's a big part of the why markets move. And who cares where they're going? We care about when they're going. So these when moments are, I think, a weakness of a lot of people. How many people kind of know what it feels like to hesitate in a support area you want to buy? You see what you kind of are looking for, you hesitate, you end up chasing it. You end up buying it a little higher, and then you get shook out only to see it rally and go where you thought it was going to go. So it's important to recognize patterns, but more importantly, why are they patterns? What's the dynamic that would make them work? How do you tie an order flow to justify the pattern? So kind of just a quick agenda page. And by the way, I don't go on for a long time. I try to give people a sense of here's some stories and analogies to pull in why it's important. We'll go to a chart from today, pull these patterns out and go from there. But these 3 order flow patterns start with a story about buying a car. Then the first one's a long up-down pattern, show you how order flow and buying, selling, and selling creates it. Head fakes and where the stop started are the next 2. So long up-down bars, head fakes, where the stop started. Real quick, how many people have been to a prior webinar that I've done? Terry, you could, if you want, chime in and let me know if there's a decent amount. I don't think I could see it, but there's a, later on, Terry's going to share a link with you for a lot of good follow-up to what I'm going to talk about today. But like I said, you'll see some of my YouTube videos searching around and bringing all this stuff together. So let's get into this analogy. If you go buy a car and you know the car salesman, he's your cousin, and he says, listen, don't buy the car today. Why not? Because we're getting 2 dozen shipped tomorrow and our inventory is going up and we didn't expect it. That's inside information. And in a sense, order flow in trying to time when you're going to buy a car. Where's price going to probably go in this example? Down, right? You knew something that you otherwise wouldn't know. So you're going to have better timing in buying a car if you knew the flow of inventory for that particular dealership. It's important to understand that because you should have aha moments in recognizing buying and selling. When people are stuck, remember that word. So let's jump into the first pattern, long up down. And this could be long down up, but let's just say, for example's sake, when you get a bar or candlestick or whatever it is you look at that shoots up, what do you get people to say? Let's buy it, right? Why not? You had this yesterday. If you guys trade S&P or stock indexes, had a big gap up higher yesterday, got everybody bullish, which is fine. You probably should have been bullish. Gets everybody to say, let's buy it. The key is if it doesn't do what it should do. So you get this big rally like this, right? I always try to put people in the mind frame of others that know a lot less. And don't take offense to this, but kids know a lot less. Kids get emotional quickly. So do retail traders. The let's buy it happens. And so what happens when you get this big up bar? You get the let's buy it and you get bids being placed for a pullback by all these images of kids. I got them ice skating around, right? These are kids. They don't know what they're doing. Oftentimes, many traders don't know what they're doing. And sometimes even professionals like myself will get caught into getting emotional. So it's not just retail, nor am I talking to you guys live or people watch us in the future as retail, but there's always times where we get emotional and you see a big up bar and all these bids get laid in and the market goes right through them. You get long and you never see the light of day. How many people have had that happen to you? If you didn't click, you'd have saved yourself an immediate 4, 5, 6 ticks. Immediate heat, right? Because your emotions got you in just like these fifth graders. All of a sudden, when this dynamic happens, you get this long bar up. Yes, I don't know if you guys see my cursor. You see this long bar up, gets all these bids to be laid in for a pullback, goes right through them. All of a sudden, it's a swear word, let's sell it. It was let's buy it, I bought it, let's sell it. So what you do is get rid of these bids. They're no longer here, they're long. They turn to sellers, correct? And the market can't get back up through that line and ends up flying lower. So the pattern becomes, let me get a pen here. What color do we want? Yellow? Let's use yellow. I like yellow. We got a yellow pen here. The pattern becomes the big bar up, shoots through all the buyers, turning them long and stuck, turning them in, saying, let's get out where we bought it, right? Essentially, if you could get a good idea where there's open, stuck long positions, that's where the guys are going to try to sell it. And all these offers create the resistance that doesn't allow it to rally. So it's a long up bar, long down bar, pretty quick, and then short retracements that send the market down. Does this work every time? Absolutely not. But it allows you to start to follow transitional moments using this. And this is the most important thing from that you're going to learn, in my opinion, today. And if you don't learn anything else, learn this. And that is, after you buy it, you're a seller. After you buy it, you're a seller. So in this example, after these fifth graders bought it to get long, they turn to sellers. You hope to sell it higher. That's a profit. But you're a seller. It could be a sell stop that you're laying below the market in order to get you out of a loser, or it could be trying to get out with a resting offer as the market comes back to let you out of that trade. Just think of the emotion of how you feel when you're in a trade and tag that to how others feel. And so stop just thinking about how you're feeling when you're in a position. Start thinking about how the market feels when maybe the market's stuck. And the best way as humans to get an idea of how other humans feel is, how do you feel, right? Because after all, you got something in common. How would you feel if you're one of these fifth graders stuck right away, not seeing the light of day, trying to get out if you're getting an opportunity? That's why resistance is resistance. So this pattern, long up, down bar, small pullback, and then a lot of time. This is the dynamic of why this is a transitional moment from bullish because of the rally here to bearish because of the quick pullback against the grain. After you buy it, you're a seller. The other two patterns, I'm not going to put on slides. I'm just going to draw them out. So let's do that with the other one's a head fake. How many people in here, another word is a false breakout? But I drew a box. I want people to start visualizing. One of the first things I would teach someone if they knew nothing about trading is how to visualize the range consolidation that I call fights. Because what's important to understand is that in every consolidation, in every range, there are open, long, and short positions. Might not be you, but there's people that are trying to fight inside this box, creating top of the range, bottom of the range, and there's open, long, and short positions. So it's fine to look for breakouts, but when there's false breakouts or head fakes, what's the dynamic that makes it go the other way? And it's this. When you start to leave the box to the upside, you got two things that just happened. You get breakout traders getting long for the breakout. So what happens? They become sellers, right? And you also get shorts inside this box that get stopped out, or at least some of them do. What happens when you stop out shorts? They are no longer buyers below the market. So you created the dynamic or the equation of more sellers, MS here, and less buyers. When you add these two together, you have better chance at downside. All right, so let me erase that and draw the box again. So you got the box, you got the consolidation, it starts to leak up and then jams right back into the box. At some point, you'll say, and I'll show some charts from today. At some point, you're scratching your head, getting ready, especially if you're bearish for another reason, knowing that people quickly, and I'll show you like what I call thin spots, quickly came in here and bought it. So you've seen what people would refer to as the delta, or aggressive buying comes in on footprints, and it comes right back against it in the middle of the box. Generally, you got a probability that this is the next direction because of what? More sellers with breakout longs and less buyers because shorts got shook out. So like I said, always remember this phrase if you don't remember anything from this webinar today. After you buy it, you're a seller, or after you sell it to get short, you're a buyer to cover that position. All right? So it's got to be almost order flow 101 to understand the other side, because that's the reasons why support and resistance are support resistance, honestly. But that's a head fake. And it's a pattern, again, where you identify the box, you see it squeeze up, and then quickly come back in. Kind of like a long up down bar where it quickly comes back against itself. But you stick some longs, shake out shorts, and then you create you clear the path to go lower. All right? So that's pattern number 2. And like I said, we're going to go to some charts from today in the S&P and the NASDAQ and take a look at that. The second or third pattern, if you got questions, pop them in. We're not ignoring them, but we'll answer them at the end. The third pattern is where the stops started. Where the stops started. So how many people use stops to get out of your trades? Put a yes in the box. I'll give you guys a second. How many people use stops to get out of trades, right? If you're long, you're using sell stops. If you're short, you're using buy stops. Probably a good number of people are using stops to get out. Most people use stops, and follow me on this one, to exit trades, mostly for losers. I know you could use stops to get into trades. I know you can have trailing stops to lock in profit, but most of the reasons stops are used are to exit losing positions, right? So just stay with me on this one. You get a market that rallies quick, and the increased buying and the flow really picked up on the aggressive buying side inside this circle. There's generally a chance, a high probability, that that's subsequent support. Why? Because the people who did not get stopped out, who wish they would have got stopped out, who missed getting out of what? A short position in this example. And after you are short, you're a buyer now, right? What do you think they're doing if the market comes way back down and gives them a chance to scratch where all the pain started. They're going to be on their knees saying, God, I'll never I'll never adjust my stop again. I'll never pull it. They're praying to get out. Let me scratch it, because they felt all this pain, right? So it's not just a little move above a box or anything. It's a rally. And where you could start to see where the flow shows you, where the order is triggered a little faster than normal inside the circle, it's going to create what I call edge zones. All right. Edge zones is a play off the name of the education, and it's also the acronym EASY. But I don't want to give people a sense it's easy, just easier to use good support resistance levels on order flow, on the notion of people being stuck. People that are stuck short inside this circle are now buyers to get out. So it's a pattern that will generally look like that, generally create some good support to look to then use order flow to qualify the damn thing. And I'm going to show you some charts on that, because it's one thing to see a pattern. It's another thing to qualify it. Like one of the things in this webinar is like TPO and profile. How many people in here would say they're proficient at profile? Probably a lot. What's one of the weaknesses of profile? It gives you a good opinion as to where the market's going, but not a good when moment. It's bullish and you're long, taking all kinds of heat, or you hesitate. Where do I get in? Where's the moments to execute? And if only people teach profile and not the execution side, that's where the skill is. That's it. You can't teach a carpenter or someone to learn to be a carpenter and just give them a pencil and say cut it at the mark. How did you get the mark? So it's that you got it. That's a big part. The when, the execution, the ability to recognize a pattern, but qualify or disqualify your strategy and your setup. So, and another thing, and I'm just bringing this up because I see it, laugh, learn, trade is a tagline I use, because if it's a stressful business, right? Every day is a little different. You could have great days. You could work all week, make money, and on Friday give it all back. And you're not on the show for it. At least a bricklayer, a wall is built, or a hairstylist, 10 people look different than they did this morning. But a trader could have nothing to show for their week, and they got up and showered and got dressed, sat in front of their screens, and did well for 4 days and blew it the 5th day. And even if you made money through the week, we pulled money out of the market weekly, monthly, all of a sudden it's like, well, what did I accomplish? All I did was trade some contracts back and forth. So it's stressful even when you're consistent. So you gotta be able to let your hair down and absorb. You're never done learning. I don't care if there's some guys in here making money and consistent. You never stop learning. You never stop qualifying location. And so it's just laugh, learn, trade. You could actually replace trade with anything. Laugh, learn, plumbing. Laugh, learn, whatever. It's just a good progression of, as I think of it, it's better to laugh, learn, trade than trade, laugh, learn. That's what most people probably do, right? Let me turn my news source off. Hold on a second. All right. So 3 patterns: long up, down bar, the head fake where market just pops up, comes back off, false breakout, and then where the stops started. If you can identify where other people might have let out some stops, you could say, where did the pain start? And if the pain started there inside that box because it rallied, you could be pretty confident that there's some really helpless shorts stuck and in a lot of pain, just dying to get out, bidding to get out, right? What do you need for support? Just think about this for a second. In order for support to be support, you need orders down in here trying to buy it. And then if the market slightly starts to move up, you got all these buyers trying to chase it. You guys, everybody knows this if you've traded for 5 minutes or 5 years. Everybody knows the feeling of missing and chasing, whether it's to get in or out of a position. That's why support would work, is because first of all, there's enough resting bids to stop it. And then what makes it go up are these resting bids start to jump, climb over each other to exit that position. So hopefully this makes some logical sense, because like anything else, if you don't know why, the where and the when become irrelevant. It really does. So those are just 3 common patterns. Let's look at a chart, and it's of today. So there's not cherry picking, or you don't see these patterns. They come out a lot. You got to know how to qualify and be able to and see them in real time. You know, how often do you read a book, watch a great YouTube video, invest in education, and if the learning, the content isn't applied to the real time, then it becomes pretty useless. Things are always tougher to read real time. That's why you got to get good in that real time. So let's go to today's charts and my layout. I don't want you guys to get overwhelmed with my layout and my charts and start you could ask, I mean, we could ask a bunch of questions about what's this, what's that, and everything else. But let's just stay on the examples of these patterns for today. And then as we are going through this, and before we get to the Q&A, the last thing I wanted you guys to be able to ask is, if there's a lot of profile traders in here, give me a price today. That profile, an area, if you have it, that profile traders were bullish or bearish. Give me an area and a time, and we're going to look at what could have qualified a trade without having to be a hindsight's 2020. All right. So let's get rid of this real quick. Let's pull this aside. This is one of my screens that I probably look at or refer to the most. Without going over all of it, we're just going to look at how some of these patterns happen. In fact, one of them happened on a footprint into the close today. If I show you guys, this is a long up down bar. Don't look at the footprint and get confused. Each column, just consider a bar. Let me get a pen back out. You can see how the market rallies really fast. You get a lot of people saying, let's buy it, let's get long. And not only did it go down, but it went down fast with a lot of quick selling, right? A lot of aggressive selling, and price went in the direction it should. So what did it do? It rallies up a little bit and falls back off the shelf. So this is a bar that was quickly up, gets everybody bullish, and quickly comes down. This happened, I don't know, 2:30 this afternoon, about a half hour before the cash closed in the S&Ps. This yellow line is just where we opened today. So that was an example of a long up-down bar, and into the close. You know, even if there's examples, they're when you get down to the close, it's kind of difficult and gets kind of whippy. Plus tomorrow's a holiday, so you got to be careful. A head fake. Here's what's interesting about a head fake, and I'm not getting into market correlations, but that's the other side of why order flow and correlation. And I got to say this because it's a big part of how you value price. Remember, I gave the car buying example in the order flow. More inventory, buy it tomorrow. Well, when you guys bought a car, did you just go to one dealership and trust the salesman because he wasn't your cousin this time and he's going to give you a fair price? No, you shopped it around. We do it we do it all the time to value price. Why wouldn't you compare the S&Ps if you're an S&P trader to the NASDAQ? Most people don't. You should. You do it as a consumer. You got to do it as a trader. So today, both of them had head fake patterns. Both of them had head fake patterns. Let me show you the S&P. Let's go back to, it was around 9:30 or so Central. Oh, I went too far back. Now, this footprint, I'm going to talk a little bit about the reds and the greens, but don't get overwhelmed by all the numbers. You don't have to analyze all of them. So what did I say? About 9:30, you could see this consolidation box I talked about, right? Where the market is trying to fight and rally or break. There's accurate assumptions that there are people short from above, long from above, but also long and short from inside this consolidation that you're seeing rotate. And by the way, that's what these bars, they look like a bunch of numbers in rectangles, but this is how you got to read it. The up and down nature of how price moves. Rotation. I use a point and figure. I'm sure that's a question people are asked or going to ask. That's the periodicity of all my charts. So this point and figure just shows the rotation that a market's price is going to have. Okay, let's get rid of those drawings. Here's the dip through the bottom of the box. Now the example I gave you on the slide was where it sneaks up the top and then sells off. This one sneaks out the bottom and eventually rallies. But what's interesting is that you had the same dynamic play out in the NASDAQ at the same time. That was the wrong one. I'm showing you the wrong head fake. This was what we call back-to-back head fake. Fakes out, rallies up, comes back down. Here's the consolidation box, because the NASDAQ didn't do it at that time. Sneaks out the bottom, actually has a long down up bar, and then the upside's the right side. Now, let's say you had this thing leak out the bottom, and it jams back up and you're bullish now, correct? Where are you wrong? That's a question that people have to know before you get in to minimize emotion, because this should rally. If you're long from anywhere in here, where are you wrong? You better not be wrong down here. It's too late. A fifth grader could say, hey, Daddy, I'm wrong down here. Okay, let's get a little better than that. But if you're bullish in here, how do you use flow to get out of a bad trade? That isn't bad. It fit to your criteria. It's just a loser. One way is when it gets through where buyers came in. These edge zones, my other chart, they draw across. Some of them draw across. I want to see where the tempo picks up and just plot me a green zone. And if I'm long, I don't care if I'm long from here or if I got caught at the top, I'm not going to be long through where buyers came in. That should be defended. So you don't have to be wrong and say you're wrong when price is obviously wrong for anybody long up here. Really important. And it's the first thing I learned when I took pit trading classes in 1997, 1998. First thing the guy said is know where you're getting out before you get in. So again, if I'm working with someone, they say, you know, Anthony, I seen this thing leak out. I wanted to get long, so I did right here. I would say, hey, that's not a bad trade. And he'd say, well, yeah, but it was a loser. Where did you get out? Well, right below where this buying came in. As soon as it got down here, I got out and I lost 2 or 3 ticks. I'd say, great trade. He'd go, but it was a loser. Your best trades are losers if you're managing your risk correctly. So don't worry about losers. Everybody in this business, especially, I'm not here to bash educators or anything else. There's a lot of great educators, good ones, okay ones, and bad ones, like any business. But everybody wants to be right. I want to be wrong and just not for long. That's what you got to be good at. So let's look at this again. This is the new consolidation box. Head fake lower that sucks in breakout shorts, shakes out longs in here. What happens when you shake out longs? You have less sellers, LS. What happens when you stick some shorts or you just uptick the amount of shorts that get in? After you sell it, you're a buyer, right? So you have more buyers. This is the equation for easier upside. And then you could also add the down up bar in here. This is opposite of the long up down bar. Same thing, only the reverse. Market goes down quick. All the late sellers want to say, let's sell this thing. They try to sell it. They try to sell it. They try to sell it. They're short. They're short. They're short. Zips right through them. They're buying. They're buying. They're buying. They're buying. They're trying to buy it. And that's what, creates that rally. Now, what's interesting about this was what was the NASDAQ doing around the same time? Let's look at just a simple bar chart of the NASDAQ. I don't know, around 9, what was it, 40 this morning? Take a look at the NQ. This is on a PNF. but a 10 PNF because NASDAQ moves a lot faster. So I'm not going to get into point and figure. But like I said, point and figure is this. Rotation. You got to know rotation for location. So this is a consolidation box that my eyeballs would fixate on. This is the leak through the bottom of it. And as soon as it gets back through the middle, if I don't have horns on, I do now. Does it mean I'm always long? Absolutely not. But it means I'm bullish inside that circle. This pattern's playing out. And I feel like the top of the box is vulnerable. All right? Head fake down. All happened at the same time. So you have two patterns in cousins, NASDAQ and ES, kind of play out at the same time. So you didn't have to be long, but you shouldn't have been short. And you should have been bullish based on this before the fifth grader is bullish. Here's the fifth grader. Here are insecure analysts, or whatever you want to call them. They're bullish up here. Well, I got 4 kids. They'd all be bullish up here too after they see it rally from down here. When could you get bullish? Not at the dead low. Let's not be perfect. But where could you get bullish closer to where it bottomed out? And you use this pattern of a head fake. So you don't get stuck. Like yesterday, the first hour, we broke 20 points in the S&P. How many times are you going to buy it before you're like, it's a reversal? How about disqualifying some longs? So I'll get into these green and red support resistance in a second. But that's kind of like where the stop started pattern. So you got a head fake pattern, long down, up down bar, all that stuff. And it's all indicative of people getting stuck on one side and trying to close the position. And that's what's creating good support resistance on their orders to get in and get out. Now, the what I want to show you, where the stops started. There was here, this is what I use for support resistance. They're called edge zones. It's where the tempo picks up. You could see that I only like them when they're drawn across. I don't like when they just come out to use as support resistance. I use that for different. But if they're drawn across and start to paint across, green for support, red for resistance. It's simple. It's where the stops are coming out. All right. Now, take a look at this one. Not just because it worked really well in here. I mean, this green, I'll look up here. This works okay a couple times, and then they blow through it. This red, where the market got fast this morning, worked great as resistance here, pretty good as resistance until it finally broke through it. But here's this support, 99 even. Let's look at a footprint and see what kind of flow, what kind of price action and order flow mean the same thing, by the way. So let's see what kind of price action was there. What time was that? What time did this guy get let out? This is where the stop started. I'm going to explain it in a second. About 10 o'clock. Central time. I quote everything at Central time because that's the zone I'm in. I don't have the zones paint across on this one. I'm looking for this one for qualifications. Get into that. So what was the price? 99. You're going to see it come back down and work as great support at 99, and then it rallies. Now, what does it look like? What painted that green across? Where a lot of imbalance. Oh shoot, I wanted to use the pen. Where a lot of imbalance, those two came out. Don't overthink this. All this means inside this circle is a lot more people aggressively bought it than sold it. We could spend a couple videos on how to determine if they're buying to get in long or get out of short. Who cares? They're just aggressively buying it. And so it painted a green line across on that other chart. And that's what it looked like in the footprint. All right. Now, that's good support resistance and only part of the skill set to get and stay consistent. The other part is define qualifiers. So I'm not going to lay a bid down in here and say, hey, I just laid a bid at 99. Even look how great it was. No heat. I made 10 points. Not going to happen, right? You're not going to be consistent at that. I hate to spoil your fun, but you're not going to lay bids on support and naked POCs and low volume nodes, and life is good. You're going to miss a lot of winners and you're going to catch all the losers. You got to have the skill of saying, hey, now is the time. And it might not be 99, it might be even. It might be 01. You don't see it in here, but in real time, this flashed red and then went away. In the room that I host, I tell people, listen, whether you're bullish or not, if you had a gun to your head and you had to pick a spot to buy it, this is the win moment. Here's where you're wrong, but here's why this box is maybe the probability to go up. And if you're wrong, you're wrong. Why red? And this is not a good example because it doesn't stay red. It's a good, in real time, it flashes red. I also have audio that is a female voice when it's selling. And so when I see a female, or when I hear a female voice and I get a flash of red here, and I'm bullish, and there's support, is when I pull the trigger. If I don't, then I missed the trade. And I got to document that because I'm going to be pissed off. The worst trades I make are missed trades. And that's true for everyone, whether you know it or not. And the reason why the worst trades you make are missed trades is because you're going to do something stupid next. You're going to do something ill-advised because your brain wants you to get over the missing part, right? So stuck, if you're going to, let's just go through this. If you're going to qualify support, you look for stuck, selling, or shorts. It's not what the market's supposed to do. It's what it doesn't do and it's supposed to. Think of as traders, we are detectives. We're trying to find out if we got the right person we're interviewing. What are good detectives? They're good lie detectors. They're good at finding tells. One of the things that I was talking to a detective, and I'm always interested in the expertise of somebody else's field. So it makes me an interesting guy. Why? Because people like to be asked what they do, right? I do it in a genuine way. So people, they don't like me because of what I got or have or whatever else. They like because I'm actually interested in the expertise of a detective, and everybody loves to talk about what they're good at. So I was talking to this detective once, and he said, "I go, well, when you're doing an interview, how are you trying to find out if they're lying or what is it that you look for?" And he said something that was really basic to him, but not to us, unless you did police work. He says, well, first is I ask him questions that I know the answers to, so I know how he reacts when he's telling the truth. Wow. So if you know how he reacts when it's an easy yes or no, or questions that you know the answer to and he doesn't know that, if you know how he's telling the truth, then you know when he might not be. It's not a perfect science. Here's another long up-down bar. The problem with this transitional moment is it doesn't retrace far enough back to probably give you a chance to take advantage of it. But it was a transitional moment. Long down bar, up bar, transition back to the upside. Plus you had where the stops started. Buy stops, right? Now, let me get back to that detective story. It's not what the market does. It's what it's supposed to do and doesn't. How do you know if the NASDAQ is weak? Because you compare it to the other markets, and it's lower, relatively speaking. It's making lows, and everything else is making highs. That doesn't happen often, but when it does, or if it does, that's an easy assessment. NASDAQ's weak. Why? Because it's down? No, it's actually up, but it's lower than the other pairs, the other indexes, right? So you got to compare it to something. Also, with order flow, going back to what set that green edge zone, remember, this right here, what did I do? Go back too far, Terry? God bless it. All right, here we go. I have to blame someone. I'll blame Terry. That's this guy right here. See this area? That's set. This area here, that nice imbalance through this edge zone. These are Sierra charts. I don't know if I'm being asked that. These are Sierra charts. I used to use Market Delta, and I never worked. A lot of you guys know me from Market Delta. I never worked for Market Delta. I had an affiliation. And then a lot of you guys know from your posts They had a falling out with a former white label that they did, and while it's unfortunate for them, it actually, I was always just using Market Delta, which I really liked. But when I didn't have to or feel obligated to use them, I found Sierra, and it's one of the few things in the industry. And I don't know Sierra, I don't have any relationship with Sierra charts, but it's one of the few things in any industry where you get a lot more for a lot less. And I don't get anything from Sierra. I don't know them or anything else. So you see this green zone here, this line rather? That area right here, right there, is what it looks like when you throw and open it up to a footprint right there. All right? Strong imbalance. Now, why is it where the stop started? Well, when you get a lot of quick buying that comes in, you could accurately assume there might have been stops that come out. But when you lift off from a certain spot, you could also assume people wish they would have got long down here or got out of their short down here. That's what makes support when we bring it back to this area where the stops started. And again, the pattern isn't what's important only. It's the rationale and logic behind the pattern. The market leaves quickly from an area. Why would it come back and then re-rally? Markets always want to test areas that it left from. So you got to get good at it. Now, all of what I'm telling you guys is useless or a lot less useful if there isn't the qualification, right? If I know that the guy's going to throw me a curveball and he's going to hang it over the plate, but I don't know how to swing, then it's useless. I got to know how to swing a baseball bat when I get a good pitch, or else I'm going to watch good pitches go by me. I'm not going to foul them off because I suck at swinging. Swinging a bat is real-time analysis as a trader. So when you guys, everybody's weakness, I don't even have to do this, Paul. Everybody's weakness is execution, is missing trades. It's pulling the trigger. It's not pulling the trigger to get out of trades after you pull the trigger to get into them. It's being a little paralyzed to get out of losers. It sucks when you have a loser. I've done this for 19 years. So while losers aren't fun, it's part of the game. It's like putting gas in your car to go to work. It's a cost that you know you're going to have. You complain. Sometimes gas is too high, but it's the cost of doing business. It's an outlay. It's a marketing expense. It's if you have a real successful business, you pay employees, but that's why so losing trades are like a marketing expense. If you look at them that way, you feel a little bit better, but they're only that way and justified that way if you're trading consistently within a strategy. And I don't give an SHIT if your strategy is any kind of line you throw up there with a crayon. But if you're consistent and you qualify that crayon support the same, you're going to trade better than someone who's done all this studying and got all the I's dotted and T's crossed. Consistency is what leads to being confident. So let me tell you this. If you have support here, okay, for whatever reason, let's say like there was some resting bids down in here. Let's say it's a TPO LVN, which you guys profile, when I say you guys, profile people like to use as a support area. Are you going to lay a bid down there, get filled, life is good, you'll catch every LVN that works as support? No, you're not. But when you see two things happen, a couple things happen. Long down up bar doesn't have to be the only thing gets you in, because what price are you going to do it? But when you see sellers that come in, aggressive sellers that shows a red, buyers that show that they're trying to defend this pullback, you don't know this is going to happen. Neither do I. All right? We know now. But what's consistent is I will stack the probabilities. You watch my YouTube videos, every day it's all about where is it probably going to go. If it gets above this red, it's got a chance to rally. Based on some sort of TPO support you had, long down up bar maybe, and then order flow that's justifying. You got selling that should get the market to go down and it exploded through it. You get buying to get the market to rotate. Things lined up. So you qualify that somewhere in here. You're not going to be long perfect down in here. But the key with location isn't buying it lower always. It's buying it where you give yourself the best chance to take a minimal amount of heat. I would rather be long any day of the week from right here, okay? Any day of the week from right there at that X than right here. Why? Because right here it goes up, tests me, and then rallies. Every fifth grader would rather be long there. They go cry to mommy, get stopped out, and then said it. Then it worked. I'd rather be long from here because it went my way ASAP. This is a better location because it's better timing. All right. So when reds get breached, it's sellers that could be saying with probability, holy, you know what. Okay. So think opposite. If another thing you take from this webinar, I know it's a long weekend. After you buy your sellers, one thing you're going to remember. The other thing is stop thinking like everybody else. Right? Take all the books you read, and I don't even know what they are. There's some good books, but take all the books you read, put them in a big can, garbage can, throw them out on the curb on garbage day, tell the garbage man to read them and then trade against him. And it's not like all these books are bad, but take conventional wisdom and do the opposite. Conventional wisdom says what? When you see selling, sell it. No, when I see selling when the market gets above it, I want to be a buyer. You got to go against the herd, but you can't get trampled either. So you got to look where the cliffs are. Picture yourself in a helicopter above a plateau with a bunch of longs or shorts below you all herded up. You don't want to get involved until they're close to a cliff. You want to be bullish for another reason than just buying every time it goes through a red or selling it every time it goes through a green, because that's not going to work either. But it's the qualification process of reading order flow to seeing where tempo picks up and where sellers can't get it to go down or buyers can't get it to go up. And you see this in a footprint or a jigsaw dome. Peter Davies is a good friend of mine. Or a heat map, something that's showing you buyers and sellers and why it can't do what it's supposed to do. But if you don't know what it's supposed to do, well, then you're not going to know the other side. If you don't know what the guy seems like and acts like when he's telling the truth, then it's going to be hard to see what his tell is when he's lying. Does that make sense? So without seeing you guys' questions, and I didn't ignore them, I don't see them, but let's get into some Q&A. And we covered the three patterns, the why they would be patterns, the execution and qualification, and how you could qualify a TPO, LVN. I'm not sure if an LVN was down there, but I know it's a big thing profilers look at for support when the market's coming down to it. How do you qualify it, and why using order flow? Using sellers that can't get it to go down, buyers who actually get it to turn, and even this pattern here. And I didn't even plan on saying this at this point, but there's so many examples of this that I don't have to look back. I look back on one day, and I looked back on right from the open, and we've seen a pattern, or from the close rather, we've seen a pattern. All right, before we do the Q&A, you want to pop in the link for, you guys don't have to sign up for anything. I've got all kinds of free content on YouTube. Go there to follow up. They're short videos. I don't believe in super long videos for every video. They're all 3, 4, 5 minutes. Highlights of the first couple hours of the day. And they're not all, trades I make in hindsight. Some of them are missed trades, and I say it. Some of them, like this week, if I wasn't long a couple times, I'd have been short. And I'll say that in the video. But guess what? I minimized my loss by knowing I was wrong ASAP. Saving money is like making money. Terry just popped the link in there. Subscribe to the channel and do the bell, because every day I put a new one up. So get yourself notified. If you kind of like this webinar, you're going to really like those, because they're shorter and they just keep following up on this stuff. Examples every day. So subscribe. You guys will like it. If you wanted further education, I'm not here to sell you on my stuff. That sells itself. Just go to YouTube first, and I think you guys will like it. So Terry, are there any questions? Maybe nobody has questions.
Yeah, there's a few. I'll get them going. So you're saying after a consolidation pattern, wait for the stock to leave the range and retrace back in the opposite direction?
Well, you don't necessarily have to wait, but when you see it, be aware. Great question. If you're waiting, fine, just be aware when it happens. Let me draw this out. So first of all, most people don't even visualize the consolidation and put boxes around them. Put boxes around them. When you see it bang around the box and you see it squeeze above it, if you want to get bearish and if it does this back to through the middle, that's exactly your moment that the bottom is in trouble. So just be aware when it happens. But good question.
All right, he says profiles by definition look at the past to define levels and value areas. A quick question: which type do you prefer, TPO or volume profile, and why?
Volume, because volume is you then separate it. Who's what's the name on this question?
Arnie?
You see it? Artie. The volume, because then you could start to disseminate buying or selling. You know what I mean? So I'm not a big profiler. I don't criticize it. I think it's good to know. It's good to learn, but I don't trade off a profile. Again, I remember early in my career, I was on the train coming from the city, and I just was getting my membership, and I was reading Stottlemyre's book, and I thought the first couple chapters, I was all excited. This is a huge advantage, and then kind of got lost. It was such a big book. But while TPO and volume are both good, I think if I were to tell you which one is more important is volume. Now, the difference between, you're right, profile starts telling you what the market did, and there's value to that. But these edge zones are real-time support resistance because it's showing you where the tempo picks up as the days, either progressing or right now or right in here or right in there. You know what I mean? These are things, no matter how good your pre-market analysis is, you don't know where support's going to lay out when it's laying itself out. You got to start watching the game. I don't know that Tom Brady in the passing game is really working well until it starts working well a little bit. If you remember the Super Bowl, I didn't know the Patriots were going to adjust to really shut down the Rams quarterback until it was like apparent that they really got this guy who's good on his heels. They adjusted. They did a couple things. Point is, there's only so much analysis you can do before the game starts. But with trading, it's different than gambling on sports, usually because you're just locked in. That's it. You got to let the game go. But with trading, you're making adjustments as the game is being played in real-time analysis. Go ahead, sir.
Okay. Is it possible to get a copy of the chart book used to produce this footprint chart?
You know what? I generally just do it to people who subscribe to my room. Just and you guys are, if you're a Futures IO guy, then or girl, I'll do it. Usually it's just room members, and I do the chart book. But if you guys want it, do me a favor.
The webinar's elite. If you want to email it to me, I can post it in the thread for
If
the
it's
webinar.
elite, then I'll do it for you guys. But subscribe to the YouTube videos to see how to use it. Then it's easier. Then you're not going back and forth to see what's what. The only thing is you're not going to get the edge zones. That's an add-on, but you're going to get the layout and things like that. So I'll send it there, and you could send it to you guys.
Do you use Sierra with their own market data, or do you use an external market data like CQG or Rhythmic?
Rhythmic is what I use, yeah, and I like Rhythmic because for heat map's sake, it goes like as much as this. Here, this is a heat map. This is a whole nother webinar to use, but this is the thing about Sierra is that there's a lot more for a lot less. It goes all the way up and down. Rhythmic is just, it's 50, 60 deep. So Rhythmic is the answer for data that I use.
Let's see. What's the difference between your edge zone and the other highlighted imbalances that don't have the edge highlighted?
Good question. They're both tagging where the tempo picks up. Who asked this question? What's their first name, Terry? Could you pronounce it?
Tommy.
Tommy, listen, the edge zones are where the tempo picks up. When it picks up to the downside, it's red, upside green. Now, what's the difference? The criteria I use inside the study setting. If you guys are interested in, when I went to Sierra, I went to a developer who developed these. And so you could go to him, but I'm not promoting him or anything else. I don't get anything. It's just he did it. And for guys who are also part of my community, first get to know him, like the YouTube videos, and then email me if you're interested in these zones. But the setting criteria, Tom, is the difference. So when you go to here, the imbalance is 987 and 225. I'm not going to get into what that means, but in order to get them not to draw across, because in my other chart, I don't want a bunch of lines drawn across, I have consecutive level 1, which means only has to happen one time to draw the line. For this guy in here, the study setting is a little different because it's 987, only 150. So the volume criteria, Tom, is a little lighter. But then I put 2 for consecutive levels, which means I'm going to get a lot less drawn. Consecutive levels is green, green, 2 things that match. And so that doesn't happen a lot with this criteria. So to answer your question, that I gave you the long answer. The short answer is the volume criteria is a little different, because on this chart, I'm looking to qualify where guys are saying and swearing, right? Where people, I'm always trying to get a sense of where, if the market made a sound where it gasps, where it starts to swear. And that's where these reds can't get it to go down, greens can't get it to go up. That has to make sense to people. Like, if a lot of selling comes in and it can't go down, you got holy SHIT money, you get, a pop. That's what's important. So that's the difference. And so I'll use these as areas to look to buy it if it's qualified, and so on. Let me show you yesterday. Like, yesterday had this gap open higher that got everybody bullish. And if you subscribe to YouTube, you'll see some of the reasons why at 21 even, here's yesterday, 21 even, I went from bullish to bearish. And if I wasn't long, I'd have been short, but I actually got long up here and didn't lose any money because I seen a divergence with the NASDAQ. But my point is that anybody looking to fade this thing at some point has to know that it's maybe a reversal. Be very careful. That's what we were saying. If you're going to get long, you better have a short leash on it. But the first moment where this is yesterday, by the way, it breaks about 15, 20 points. The first moment was into these old edge zones that came across, and there's 2 of them. But that doesn't mean you lay a bid and buy it down in here. But as it started to breach some of these reds that came in, that's when the upside became the right side. And it rallied about 6 or 7 points before it came back down on top of it. So you're trying to fade and get long a big break like this. If you're picking better spots, you either could make it work or you don't have to get killed if you're in a good spot and you're still wrong. So that's what it looked like yesterday. If you're going to fade it, this is the best spot to fade it. I was looking early to, I thought I had some stuck shorts, and when I seen the NASDAQ pop and we couldn't rally, I said, the hell with this. And I said that to guys in my room. I says, NASDAQ just rallied 8 points and we can't budge. Be careful along. And then sure enough, we started to break. Again, the YouTube videos cover a lot of that stuff. But
Okay, let's see. Do you ever consider VWAP?
I do. I got that here. I got this white line is the VWAP, and that's I like it for targets. So if I happen to be long and the VWAP comes into play, I'll exit some or all of the position. So that's what I use it for, not to get in, but generally to exit if I happen to be long and it rallies up to it, or short and it breaks down to it. But I think the VWAP is good. If you notice, you don't see a lot of crap on my screens. It's just green or red lines that come across, and then a VWAP, and that's it, right? As far as that goes. But call me a liar, but see how well these work when they get drawn across. It's not coincidental. And then when good support doesn't work, it's usually indicative of some really good downside. Look how well they work as support in here, how well they work as resistance until they don't, how well they work as support in here, resistance up in here. In here, they chop around resistance, right? Here, they come across its resistance in the NASDAQ before it's not. Here, it's resistance, and then it breaks out. Here, it holds once on a couple rotations, breaks through it. So they work. Even now, you got to qualify them, right? Qualify around.
Can you comment on how to use order flow in thinner markets like crude? Does it work the same as thicker markets like ES?
Crude market. Yeah. So crude really used to be thinner than it has been the last year and a half. It got thick. So I'm always adjusting. I don't trade crude, but I watch it. So my levels aren't tweaked as some of the other guys in my room and girls that trade it because they're tweaking them. But yeah, thinner markets, it's the same concept. You just lower the criteria for it. You know what I mean? So if you look at oil, it comes down in here, it rallies off this zone, right? Comes down in here, rallies, and uses almost every one of these green zones as rotation before it finally lifts off. There happens to be a lot sent across here, and you know why? Because the market got fast on the way up when it went up. And that's why it sent it across. I've got my ES levels tweaked better than oil. That much I could tell you. But same concept, whoever asked that question, only, and I got to roll it to June, but same concept, you just criteria of what creates an imbalance is a little different. And oil's a great market because it used to be a tough market to be the first market you were going to be successful at because you couldn't trade it. It was expensive to trade. You trade a one lot and it moved around. It's $10 a tick. Now it's thicker. You can get out easier. And so it's a market that in the past, I would never encourage someone to trade if they're not successful yet. Again, it's a very difficult market to be the first market you ever started making money and consistent. Now I would. Now it's not a beginner's market, but it's cheaper to trade in a sense than fly around like it used to. Hopefully that answered his question.
All right, we're getting close to time, so I'm just going to ask these last two questions and then we'll cap it. What time frame are your charts? And can you quickly recap how you qualify your edge zone?
Yeah, so I use PNF number one, and point and figure is what it stands for, and they're 4 rotation. Goes up, if it goes down 4 ticks off to whatever the high is, new bar is set, and all that means is this: follow my yellow pen. It's just rotation. So I use a 10 PNF for oil and NASDAQ, and a 4 PNF generally for the ES to show this. I use that as like a bird in the sky. If you're following a bird in the sky and left a trail, that's the kind of paradise you want to use. I can't get that out of 5 minutes or 15-minute charts always. I like point and figure for that. And so the other question, how to qualify, it's essentially an imbalance of when, if you have aggressive buyers that lift an offer and aggressive sellers that hit a bid, if there's a lot more buyers than sellers, it'll go green, either flash green on this chart or throw a green edge zone if it qualifies on this chart. But they're imbalances that meet a certain volume criteria, so you don't have too many or too few. But essentially what it's telling you is where tempo picks up and where potentially other people are stuck. That's the key to this business, is the S word, stuck. You got to find where they're stuck. If you don't, and if that's not part of your vernacular, it's not part of your industry speak, then it's got to be, because you're in a prop firm, you're going to hear this word in words that rhyme with it all the time.
Okay. Thank you for the webinar, the information, and for spending some time with us this evening, Anthony.
My pleasure. Again, subscribe to YouTube. There's good stuff on it, especially if you have questions that you think of that you didn't get to ask, because they'll be answered in those. But have a good weekend. Have a safe weekend. And Terry, we'll talk to you soon.
Absolutely. Everyone have a happy holiday Easter weekend. See you later.